Welcome to the latest episode of Quest for Twice. In this episode, I'm going to provide an update on the energy transition review provided by DNV GL. But first, I would like to provide a quick update on my investment portfolio. So as of yesterday, 36% of my portfolio is in Adcore stock, and then 22% is in energy sector, including Energy Transfer and Kinder Morgan. 23% in small value stocks like Ingredion, Walker and Dunlop, and Method. And 14% in growth portfolio, including InMode, Amazon.com, JFrog, Boston Beer Company, and Poshmark. I have roughly 5% in cash. So as of yesterday, my investment return in this year so far is about 58%, handily exceeded the return of S&P 500 in this year. Since I have a significant position in the midstream oil and gas company, it's important to understand the long-term threat to their business from energy transition. So each year, DNV issues an energy outlook about the pace of energy transition and its forecast. DNVGL issued one last month, and it's interesting to compare that with the one they issued about 1 year ago to understand how their view has changed. In last year, I provided a review of their energy outlook, and at the end of the review, I stated that I believed their outlook was too optimistic about the speed of the transition, because they were making some unrealistic assumptions about people's behavior. At least in my opinion, they were too optimistic. So let's take a look at their forecast in this year's outlook. Future energy demand is driven by the world population growth and GDP growth per capita, as well as efficiency gain. So in the bottom left graph, the green bars are annualized the population growth, and the dark blue are the GDP per capita growth, and the light blue are the energy intensity improvement. So basically, the increased demand for energy from population growth and the GDP growth will be offset by the energy intensity improvement. So it's like a large number subtract from another large number, and the difference is the annualized energy demand growth is a very small number. By definition, when you look at this type of math problem, the answer is very difficult to forecast, because just a small error change in the two large numbers can result in very large change in the final difference, which is the energy demand growth. So it's not surprising that from 1 year to the next, DNV forecast may have changed sometimes significantly. So the population growth and the GDP growth are difficult to forecast. But even more difficult is to forecast future energy intensity improvements. So in the bottom right chart, it shows the historical energy intensity improvement from year 2000 to 2020. The improvement usually is between 1 to 2% each year. So in the DNV's forecast, that improvement is going to be over 2% for the next 30 years. Then the immediate question is that too optimistic? And we need to understand what's driving the significant pace of energy intensity improvements in DNV's energy transition outlook. This slide shows the DNV forecast of world energy demand to 2050. On the left is the latest 2021 forecast versus its forecast from 1 year ago. So the energy demand is broken down into different sectors, including transport, buildings, manufacturing, non-energy use, and others. At the first glance, those two forecasts look similar. But if we look carefully, we can actually see that the 2021 forecast shows higher demand in the future, for example, in the year of 2030. And also it stays high with a slower decline compared to the forecast from 1 year ago. As I alluded earlier, I think last year DNV assumed some society behavior changes, which I thought that was too optimistic. And also if we compare those two graphs carefully, we can see that the blue region, which is the manufacturing, the 2021 forecast has a slower decline after 2030 compared to the forecast 1 year ago. The manufacturing sector is hard to decarbonize and realize efficiency gain. So I consider the 2021 forecast is more realistic. This slide shows the world energy demand by the road transportation sector, which is about 20% of the total demand in last year. Again, the forecast from this year is on the left and comparing to the forecast from last year. Demand is by the different type of energy source. The red region is oil consumption. That's the primary energy source for road transport at this point. And the blue region is the electricity. When the road transportation switched the energy source from oil to electricity, it actually improves the energy intensity. And that's the main driver of the energy intensity improvement, the DNV forecast, as I mentioned a couple of slides earlier. So comparing this year's forecast with the one from last year, we see that the 2021 forecast has a higher demand after the recovery from COVID-19 pandemic. And the peak stays on and maybe plateaus between 2020 and 2030, comparing to the assumption a relatively fast decline from last year's forecast. And also if we just eyeball the region of the blue area, we can conclude that this year's forecast assumes a less rapid adoption of electrification in the transportation sector. Considering that people generally like the status quo, I think this year's forecast is more realistic. Another way to consider this is to compare with the forecast from Bloomberg. So that's small graph on the right, and the blue region is the emission from road transportation. So it's a proxy for the oil consumption in the road transportation region. And we can see that in this year, the forecast is a little bit closer to what's being forecasted by Bloomberg. Still, this year's forecast has a faster decline of oil consumption compared to what's forecasted by Bloomberg. It's just not as big of a difference as between last year's forecast and Bloomberg's forecast. This slide shows the forecasted world oil demand. Again, 2021 forecast is on the left, 2020 forecast is on the right. Comparing those two graphs, we see that the 2021 forecast has a higher demand in this decade. However, if we compare the oil demand in the year of 2050 between those two forecasts, we see very little difference. That implies a even faster decline in oil consumption after the year of 2030 compared to DNV forecast from 1 year ago. That fast decline is driven by the speed of electrical vehicle adoption. So it remains to be seen how fast that adoption will be. I think the jury is out. But at least for the near future, the world still need a lot of oil, as reflected in DNV's 2021 forecast. This slide shows the world gas production. So similarly, 2021 is on the left versus 2020 forecast on the right. So comparing the production forecast, the 2021 has higher production in this decade comparing to a significant dip forecasted last year. And in the 2021, the gas production has roughly plateaued, then start to decline after 2040, versus the forecast from 1 year ago. The gas production will increase significantly in the coming 2 decades and reach a peak that is higher than the 2019 production, then decline afterwards. So DNV becomes a little pessimistic compared to 1 year ago about the role natural gas will play in the future energy mix. As an investor in the midstream company, I feel that my investment will be successful if the production volume will be there. It doesn't have to go higher for my investment to succeed. So I'm not worried about the updated forecast from DNV. The gas demand is sensitive to price. So currently, the natural gas price around the world really has increased significantly compared to last year and compared to historical highs in Europe and Asia. So it's conceivable that the gas production will decline in the future if the gas price stays high. But on the other hand, the high gas price usually will incentivize higher production, which will help to bring the price down. So it is a dynamic situation. It is very difficult to forecast. To me, if the gas production stays flat in the next 2 decades, then my midstream companies will pay steady dividend and distributions, and that's my purpose in that investment, and I will not complain about that. So to summarize, DNV in 2021 has forecasted a slower pace of energy transition in the coming decades. As a result, it implicitly forecasts that the oil and gas role in the world energy supply will not diminish as quickly as it's forecast 1 year ago. And that's a positive news for oil and gas investment. Of course, DNV still sees rapid adoption of electrification in the transportation sector, as well as building and industrial sectors. And those sectors, electrification will present the investment opportunities, for example, for companies like Adcore, which provides electric conduit. So in the comment section of this video, I have provided the links to the review of DNV energy transition outlook from 1 year ago for easier reference. Until next time, happy investing.